Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in there. We're going to take a look, see what people are sharing, and I'll share my opinions as we go. If you want to follow me at Finance, and if you want to join our community, finding-value.com. This is a community where we meet basically on the weekends. We do record those and put them on the website. It's question and answer sessions. We do talk about the markets. I do some trainings during those and share my opinions a lot more freely about individual companies, my portfolio, and how I'm playing this commodity bull market that we have coming up. And if you're interested, we have a coupon code MAYDAY, MAYDAY, that is still active in the system for discounts. Top down charts, VIX seasonality update. Look at 2024 in August. Oh my God. Look at the VIX seasonality off the chart here. What that means is the volatility, and the VIX is the S&P 500. That volatility there in the S&P is off the charts here for August. We had a lot of volatility ending this past week, and that is spiking it. I highly doubt it's going to stay up here, but that is a major spike that we have recently seen. Some people think it's from the yen carry trade, very well could be, and some of that unwinding from that trade where people would borrow in a certain currency, the yen in this case, and invest it in other currencies for a low interest rate and also for currency exchange differences. Coming down, the business cycle and assets. This is something that I posted. So let's go over the business cycle real quick. It is related to the real estate cycle. I'm not going to go over the real estate cycle all that much, but this is the business cycle and which assets perform well during certain portions of the business curve. So this is the business curve. There are four phases, just like the real estate cycle: contraction or recession, recovery, expansion, and slowdown, which is they call that the hypersupply phase in real estate. So below capacity declining, above capacity declining are the ends. And then in the middle, recovery is below capacity and growing. And then phase three is above capacity and growing. And your capacity is this line going across the middle. I use that as average. So capacity is average or something in the middle that the cycle moves about. Now, in these phases, there are certain assets that do very well. And you can identify where you're at in this cycle depending on which assets are outperforming. So they have four different assets: bonds, equities, cash, and commodities. And they are put in order depending on where we're at in the cycle. So outperforming in a contraction phase is bonds, then equities, cash, and then commodities do the worst in a contraction phase. As you move into recovery, equities, commodities jump up to second best, bonds and cash is worst. Then in the expansion phase, when we get into the expansion phase here, and you're part of the website, you guys already know this. Commodities are the leaders, equities, bonds, and then cash. And then during the slowdown phase, we've got bonds, commodities, cash, and equities. And sometimes the market has hiccups in the middle of a real estate cycle. So we can go, the business cycle could hiccup in the middle here. So what you'll see is sometimes the business cycle is a shorter contraction of the real estate cycle. And when we go into an expansion phase, which is phase three, in a underbuilt scenario, so we expand into real estate, what occurred this past cycle, in my opinion, is we probably raised rates due to stimulus money and all this stuff coming in the system. So stimulus money is a big driver of inflation. And then also the bank and credit being grown in the system from the expansion phase of real estate. They raised rates rapidly. not only just rapidly, but they raised them to a pretty high level compared to uh, the historical 5 or 10 year average. And that slowed down the housing market. And I think it's going to put us into this slowdown phase. And I know some people say, well, what's a slowdown? I said, well, this is the slowdown. And then when you slow down, you could potentially get a recession or a larger slowdown behind it, depending on how far down this goes. Sometimes they cut rates and it's a shallow contraction. Other times they are too late and they do catch up rate cuts because the momentum in the system is falling too fast. So that is what is considered a soft landing, the first one, and then the second one's a hard landing. So they're behind the curve, they're too late. Commodities generally go down in these contraction phases, and it's a really good time to look at commodities here when we transition from phase one to phase two, depending on how low we go. I think it's going to be a big commodity boom because the real estate cycle, which is overlaid on top of this business cycle that goes back and forth, is still in an expansion phase. So the business cycle, when this goes up and down, most of the time it's 100% driven by uh, the economy. There's no stimulus, there's no outside factors. I think as time has gone on, we are trying to control this business cycle with greater and greater amounts of outside stimulus, whether it be from controlling interest rates, either to the downside or upside, and also money creation that is driven by fiscal pumped into the system. So there is this potential where humans are going to mess up and put too much money into the system or put rates too high. And that is a potential problem when trying to basically control an economy. And then coming here, this is the yield curve in the business cycle. And I think there's a huge amount of value here. So interest rate and yield curve patterns over the business cycle. So when you get to peak, and that's the peak of it, and then the trough is the bottom. And then you've got the long-term rate that moves up and down part of this. So you've got the long-term rate's the solid line, the short-term rate is the dotted line. So when you go to the peak or when the cycle is up, you'll get an inverted yield curve where the interest rates on the short end are higher than the long end. That is signaling that you're in that expansion phase. And as it goes up, that is when you get the interest rates going up here. The interest rates start to go up when you pass this average here and go into this expansion. They raised it pretty quick. So it was short-lived in this expansion phase because of how fast they raised those rates. And that's the yield curve inversion. When we start to come down mid-cycle, either going up or going down, you'll get a flattening of the yield curve. And sometimes you pass through it very quickly. So you can pass through it where you go from a low short-term interest rate, it goes up, and then you come up. That is an expansion phase. And then you cycle back down in a contraction. And it goes back and forth with these yields and interest rates going up and down, and the yield curve inverting, uninverting. And then it recycles, inverting, uninverting, and the cycle goes back and forth. That is the business cycle and what this is. So what you can do is you can look at the business cycle like we've got here. We can look at the yield curve, and if it's inverted or inverted or not inverted, more of a normal curve versus an inverted curve, then you can tell where we're at in this cycle. You can also tell where we're at in the cycle by comparing these in ratios, because if equities are outperforming commodities and bonds, then you know you're in recovery phase. If you know in phase three that you're ripping it in commodities and equities are lagging behind, then you know that you're in a commodity phase. And then you can do all of these ratios and say, yep, commodities are ripping it and the yield curve is starting to invert and we're going inverted. We're in the phase three expansion phase then. If we have bonds outperforming and the market is slowing down and inflation is slowing down, well, then we're in a slowdown phase because bonds are going to start to outperform, not versus commodities. And I think that is where we're at today, probably, is in the slowdown phase four. Bonds are starting to outperform. We just broke out recently, and we could enter a contraction phase depending on the response to all this. So we could have commodities drop down and start to underperform for a period of time. But the bigger cycle over this, there's multiple cycles that span way over this cycle here that goes up and down. There are other tailwind factors that are bigger than this cycle here, like the Kondratiev wave and some other larger waves like the real estate cycle, which is driving this, which could overpower some of the shorter term signals. Although the shorter term will be there and we could still go down, it won't go down as much if you're at an end of cycle where they all are turning lower. So there are many cycles that overlay on top of each other. It's not just this one. JC Parrott says, is it bearish that consumer staples just went out at new all-time highs? Or is it just normal for staples to go up also during bull markets because they're stocks too? And I think he's kind of joking here. Consumer staples are generally kind of an indication that maybe a slowdown is coming. That's generally when they outperform. They go sideways during other market conditions and don't really go anywhere. This is the SMCI chart. I was looking at Jesse's post down here, and this is the chart that I see and how I chart it. And I was like, wow, this looks really familiar to Jesse's chart. So this is the chart for the semiconductor super microcomputers here. Look at the chart here. It's almost like we're right just coming off this move there. So you pull lower and then you pause and then you could potentially come lower. And it's almost like we're right here in this. Like this here is the bull trap, is what they call it. And here, this what he's got is NVIDIA share price still uncomfortably resembles Cisco Systems Incorporated, which played a similar role in the development of the internet when it peaked during the dot-com bubble in 2000. And I overlay multiple things. These are called fractals and how they interact with each other. And this chart here is the same fractal, just a different company in, NVIDIA semiconductors, same with SMCI. So I think we're right over here. So we'll see what happens. And to me, I mean, if it looks like a bubble, acts like a bubble, and we're in the market conditions where these things go down under, I mean, to me, I would say, yeah, it looks pretty much like a bubble. I know calling tops is really difficult, and I'm not necessarily calling the top, but it kind of looks like a top. That's what I'll say. Tom McClellan, he says, here's another way of seeing the percentage points spread between the Fed funds target and the 2-year. I added the New York Stock Exchange AD line for comparison. When the Fed is way too high, the spread is negative. This tends to be bad for stocks and for the economy, but stimulus takes a while to work. So this is stimulus here. This is restriction underneath. And what this means is he compares the Fed funds rate with the 2-year rate and the spread between the two. And whenever there's a big spread where the 2-year falls and the Fed funds rate is over it, that's that restrictive area. And we're in that restrictive area right now, pretty low. So that's what that means. The spread between the 2-year T-note, which falls and front runs the federal funds target. Lawrence McDonald says Berkshire Hathaway sold nearly half its stake in Apple. Buffett has been aggressively dumping stocks and raising cash. And that goes back to these charts here of these potential bubbles and where we're at in this business cycle. Warren Buffett is secretly a real estate business cycle expert. He really is, because I've seen him play these cycles over the years. He invests at the right time for a lot of his oil investments, and now he's selling at the right time to dump technology stocks. So Buffett's Berkshire sells $3.8 billion worth of Bank of America in a 12-day selling spree. He's also selling Apple. And there must be a problem maybe with Bank of America. He sold 90 million shares in 7 days. It's highly unusual. Something's going down. Breaking the SOM rule, recession indicator surged to 0.53 in July from 0.43, suggesting the U.S. economy is in a recession. The SOM rule signals a downturn once the unemployment rate increases zero point 0.5 percentage points above its previous 12-month low, and here we are going above that right now. Here's a quote from Charlie. He says, if you want to succeed in investments, start early and try hard and keep doing it. All success comes that way by and large. This is Charlie Munger. So if you haven't been successful, keep trying. I can help you if you need help. And you can see how I take positions. And obviously, there's other people that you can follow and see how they take positions. And maybe you can learn from people who've been doing it for a while and the reasonings behind it. Obviously, some people are better than others, and you want to take the best of each person and their approach and strategies. Josh Young says the last time hedge funds were this bearish in commodities, prices surged, particularly oil. So hedge funds turned bearish in commodities for the first time since 2016. 2016 was actually a really good time to buy mining stocks. I don't know if you guys saw that move in 2016, but I remember buying it was a falling wedge in a lot of those mining stocks, and they ripped for a few months. It was such a fun ride. I think something very similar is occurring here. And when this falls down, I mean, this is hedge fund turns bearish on commodities. This just means that the sentiment is real negative. It's usually a good time to be looking. Wow, Buffett running for the exits. He sees what's coming, and it's Warren Buffett, Berkshire Hathaway sold nearly half its stake in Apple. The tech boom going into a tech bust. Maybe that's what they see potentially. Says they dumped nearly half of its gigantic Apple stake in a surprising move. And it was also a surprising move when they dumped Bank of America up here too. Highly unusual. Interesting. Latest world GDP weekly using AI model, slowing but not stopping. So we've got the World Weekly Economic Activity Index, and it is slowing, but it's not going below zero. It's not stopping and going negative and contracting. It's only going down and slowing. It's still in positive territory. JC again, it says that was the highest weekly close in the history of gold and a new all-time high for a weekly close for gold. It looks fantastic, guys. Really does. I love these charts here. Warren Pye says this was a great tweet from Citrini and is something to remind yourself of as every perma-doom account takes a victory lap after an NFP report showed 114,000 jobs with very few layoffs in cyclical sectors. So personally, he says, I'm comforted by the cocksure recession calls all over Twitter. Says the best outcome for us right now is for investors' opinion to rapidly oscillate between certain recession and economic reacceleration every other week for the next 3 to 6 weeks. That's what the soft landing looks like, in my opinion, according to him, which the data goes back and forth, which it's not really data, it's just the price being volatile, consolidating sideways. And that very well could be an outcome. And a soft landing maybe is possible. I know Warren Pye has shared some things about potential soft landings, how the 2-year yield drops in front of soft landings. So maybe that's an outcome, and maybe it's not as bad as what people think. The real estate market still looks pretty strong in terms of employees employed in construction and construction spending. So I'm not in the hard landing camp where it's driven by real estate. It's definitely not driven by real estate, in my opinion. It's driven by other things in the system, and it could be a soft landing. Fingers crossed. Howard Marks says too much capital availability makes money flow to the wrong places, says Howard Marks. So that's called the misallocation of capital. So if you've got too cheap a capital and too much capital in the system, there are businesses or things that grow in that type of environment that wouldn't normally grow in a higher interest rate environment. They call that basically an interest rate at a certain level is kind of like the hurdle to jump over, the hurdle rate. Chapter 11 filings, which is bankruptcy, reach highest level in more than a decade. That's been trending up higher for bankruptcies or chapter 11 filings. This chart is wild. Ask yourself, what does Buffett know that I don't? And Berkshire cash pile hits a record 277 billion as it slashes Apple's stake. And this is way up here. So maybe he's seeing a recession or a slowdown and he's building a fortress of cash, perhaps. He's probably waiting for the false flag event to occur in the future, and he probably has insider information of it, maybe. So you stack a bunch of cash and buy when everyone's in full fear. A pretty big spread between okay, I already went over that one. Everything that I've seen indicates that there's absolutely nothing wrong with oil demand, and that's true. But now your macro environment is overwhelming the sector fundamentals. So keep that in mind. I know a lot of people say, well, uranium's short or oil's still, demand strong and we're still running deficits. That is all true, but in the short term, when people get fearful from macro conditions, and then people just click there and hit the sell button. Sell, 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 sell. From fiscal dominance back to monetary dominance. So monetary is that bank lending that we get in a real estate market boom. So when we go negative, it says government spending falling year over year. So it's been falling, but this is the fiscal spending upward, these two areas here, and it's been coming on down. And what he's got here is this is global central banks cutting at fastest pace since COVID. So global central bank rate cuts. So what they're doing is they're ramping down fiscal spending, perhaps, which is the first one here. And with the rate cuts, that's going to ramp up your credit creation from monetary side. So it's almost like they're doing a transition here with a little bit of bumps in between. Bitcoin says this indicator has a 100% success rate, 5 out of 5, at predicting a drop of 70% or more. It just triggered the signal for the 6th time. And he's using this indicator on the bottom here for what is a BTC bull market and bear market. And right now it's crossing where we could be entering a bear market. In the fall, each time this is crossed, 80% fall, 80% fall. We've got another 80% fall, 70% fall, 80% fall as this oscillator goes back and forth of two different time frames. And right now it's crossing back into bearish territory. And we'll see if that holds, this momentum indicator. We'll see if that holds there. And then the volatility trading, this is currently the 5th largest spike in the VIX spike in history, up 25.76%. We had 2 of those in 2020, March 16th and June 11th. And then in February 5th, 2018, we had a pretty big spike. And then also in 2021. So we're getting a lot of very big VIX spikes more recently in history because there's 1, 2, 3, 4, 5. The top 5 have all occurred from 2018 and onward. All 5 of the top 5. And then you can also see there's a bunch down here. March 9th, 2020, February 2007, 2018, 16, 2020, couple in 2011, 2020. What's with the volatility increasing over the past 5-10 years? What's going on here? Kind of interesting there. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. And we'll catch you next time, guys. We'll see you later.